Hi, I'm Joe Davis. Welcome to Jodo Financial. I'm excited to be offering you alternative viewpoints on the traditional wisdom of personal finance. So, we're going to be taking a look at various perspectives of commonly accepted practices and making sure that we adjust our strategies to make the right decisions for our money. So, with everything happening in the world, current events, politics, legislation, things change over time. And it's important that we also change our concepts in personal finance, again, to do what's best for our money. In this video, we're going to look at three things. One, we're going to talk about the pros and cons of a high yield savings account, also known as an HYSA. Two, we're going to discuss inverted yield curves and what they mean. And most importantly, what do they foretell about the future? And then three, we're going to tell you where you should probably be stashing your money instead of a high yield savings account. So let's start off though by talking about the pros of an HYSA. As most of you have had savings accounts throughout time, you'll know that their biggest advantage is that they are liquid and you can easily access that money. So they're recommended for emergency funds. If you're going to be depositing money for a house in the near term or need to make a big purchase, then you should definitely be keeping your money in such an easily accessible account, such as an HYSA. Second benefit and perk is that they are FDIC insured up to $250,000 per account. So that means it's backed by the federal government. There have been some banks that have gone under in the past couple years, Silicon Valley Bank, First Republic. So in those situations, your money cannot go away. The federal government will give you whatever you've deposited into the account up to $250,000. Third, they pay a good interest rate right now. So a high yield savings account pays about 4.5%, which for a risk-free FDIC insured account where you can access the money at any time, 4.5% is a pretty good rate. So what about the cons of a high yield savings account? To be honest, I don't think there really are that many negatives and downsides. I just think that there's possibly some better places you can be putting your money. So that leads us into the next topic of inverted yield curves. Now, they might sound kind of scary, but they're really simple. And if we start with a traditional yield curve, then you'll see what the opposite or an inverted yield curve looks like. So with a traditional yield curve, you would expect that the longer you put your money in a bank, the longer that you loan it to somebody, the higher the interest that you'll get paid for that, for locking up your money for a longer period of time. And so, for example, if a high yield savings account is paying 4.5%, you might expect a 3-year CD to be paying 5%, or, a 10, 20-year promise to pay maybe 6, 7%. And that's not happening right now. The reason is, as we're discussing, there's inverted yield curves. So what that means is the longer out actually pays less. So right now, CDs that are 5, 6-year CDs are maybe only paying 4%. So I created this little doodle that might help. Typically, a 5-year rate will pay more than a 2-year rate. Very common sense, 5 greater than 2. But with an inverted yield curve, we flip that around, invert it, and you'll notice that the 2 is greater than the 5. So right now, smaller time windows are actually paying out higher interest rates, and hence the term inverted yield curve. So what does that mean? What does that foretell about the future? And what it means is hedge funds, experts, everyone in the financial markets is expecting that interest rates are going to go down in the future. So if we extrapolate that out, that also means that your high yield savings account will no longer pay 4.5% in coming years. The interest rate's going to go down on that. And since you don't have your interest rate locked in, you'll also see that your interest payments go down as well. So that's kind of the crux of the video. It might seem that a high yield savings account is a great place to put your money. You're enjoying those, good interest rates, but that is just for the time being, and we expect that to change in the near future. So that's the paradox. Everyone thinks that rates are going to go down in the future. So if you like looking at that 4.5%, you need to lock it in now, and I'm going to show you how to do that. So how do you take advantage of interest rates in the long term? A lot of people are going to buy CDs, and there are some good features to a CD, But nothing can compare to treasury bonds, also called T-bonds, that are backed by the federal government. So we're going to take a pause here and look at some historical data of why you should be considering buying 10, 20, and 30-year treasury bonds. So if you look at this chart, in 2007, that was the last time that interest rates were this high. So you could be in a savings account earning 4 or 5%, and you would be just as happy as you are now. The problem is that that rate, again, is not promised beyond tomorrow. So the entire decade of the 2010s, interest rates sank to near zero. So if you had your money in a savings account in 2007, you would be getting no interest from 2010 to 2020. And we want to prevent that from happening in our future. We want to make sure that we lock in these interest rates now. So historically, when things were good, you needed to lock it in, and we don't know what the future will bring. So I want to make sure that you consider locking in that 4.5% with T-bonds right now. But before we get into that, I do want you to consider some unfavorable parts of T-bonds so that you can make a fully informed decision. So as I mentioned, if you need the money this year, definitely keep it in a high yield savings account, especially your emergency funds. But money besides that is probably good to move into treasury bonds. But other things to look at is remember that the inverted yield curve is just an expectation of what the future brings. So we think that rates will go down, but they could also go up. And if rates go up, you would probably want different strategies rather than buying long-term treasury bonds. And then 3, this should be the money in your portfolio that you're not putting into the stock market. So this is your risk-free money that you want to make sure is there for the future. All right, so now let's get into all the reasons that we should be considering purchasing T-bonds and moving a lot of our savings account money into those treasury bonds. And, I'm going to break the rule of 3 here. I think there's maybe 5, 7 different reasons that T-bonds are going to be beneficial for you. And the first one might be the most obvious. If interest rates go down, then your treasury bonds still have that locked in rate. And so everyone who has savings accounts and sees their interest dwindling each month, you're going to be on the other side of that, getting the same income payment every month with treasury bonds. So that's probably the biggest reason to make a long-term purchase there. But, another thing to consider, and much like CDs and the savings accounts, this money in the treasury bonds is backed by the U.S. government. So the federal government promises to pay on these bonds. And, in all our time, they have not defaulted. And so across all financial markets, when everyone's doing calculations and considering what's best for their business, this is considered a risk-free rate. So nothing in life is 100% risk-free, but as the ethos goes, treasury bonds are pretty close to risk-free. Third, unlike savings accounts, CDs, you can sell treasury bonds on the secondary market. And what's even more exciting about that is as interest rates go down, the value of your bonds go up. So you can actually make a profit on selling your bonds. And that's just not a feature of a savings account. And then there's even a further added bonus if you do wait a year and sell your bonds and, make a profit because interest rates have gone down. Then that means that you're eligible for capital gains tax rates, which are usually lower than income tax rates. So a lot of advantages there. But most importantly, I want to talk to the 25 to 55-year-old crowd. Retirement might seem a long ways off, and to be honest, it probably is. But if you consider retiring early or seeking financial independence, you're going to want a guaranteed income stream that is, generally risk-free. And so that's why I suggest considering buying these 20 and 30-year treasury bonds now, because in 10 years, we don't know where the financial landscape is going to be. We don't know what interest rates are going to be. And if interest rates go back down to 0%, it's going to be nearly impossible to find an income stream that is risk-free that you can use to retire early. But if you buy these bonds now, then a 30-year bond in 15 years will still have 15 years left of making those payments at 4.5%. So it's just that peace of mind that you'll have no matter what happens in the future, you'll have this income stream. So sure, interest rates are high now. That's why you have money in your savings account and you're happy to see it. And that's why I made this video, to tell you, you probably shouldn't have it there. If you're excited about how well it's paying out, then lock that rate in for 20, 30 years and buy US Treasury bonds. So I just want to make sure that you're taking a look at all the different perspectives of where you can be putting your money right now. And, if you're excited about 4% interest, because we had a whole decade where you could barely get a percent. If you're excited about that 4%, then lock it in now. Look into buying some treasury bonds. We'll have a future how-to video on going into Treasury Direct and how you can purchase those bonds at auction and lock in those interest rates so that even when they go down in a high-yield savings account, you'll still be getting 4.5%. So thanks for watching this video and considering if this is the right strategy for you. This advice is not going to be perfect for everyone, but you should consider if it's right for you. So if you want to continue to get different perspectives, the alternative viewpoints, then please subscribe to the channel. Feel free to comment in the comments if there's topics that you'd like me to cover. And so for Jodo Financial, this is making your money work for you so you don't have to. I'll see you next time.